Good day to everyone. Today we're going to discuss the remaining modules of our class. That's financial planning, and forecasting, and working capital. Now, I already uploaded the PowerPoint slides for financial planning and forecasting, and also the working capital management. These are recorded PowerPoint slides. So it takes you through the different slides. So I will not be discussing them anymore in this recording. Kindly listen to the explanation for financial planning and preparation in this PowerPoint slides, and also for the working capital. Most of the topics in the working capital management, especially in the management of cash and management of receivables, we have already discussed in class. It's only the management of inventory that has not yet been discussed in class, but it's already discussed here in the PowerPoint slides with recording. So uh, now I'm going to discuss the remaining parts of the financial planning and forecasting in the Excel file that we were using last time. So may I invite you to open that. Okay, so we have discussed this. We have gone through NPV, IRR, MIRR. Then we're going to discuss the last two worksheets here. First is the break-even analysis. Okay, for break-even analysis, we are interested to know how many units a company should sell so that it's able to recover the costs. Now, as far as cost is concerned, we are looking at two types here. We have fixed costs and variable costs. Fixed costs are costs that do not change, uh, whatever the level of output of the company is. For example, if the company rents a certain place, they're renting it, let's say, for 100,000 per month. Okay, that cost of 100,000 per month rental will not change no matter what the level of output or no matter what the level of activity of the company. If the company produces 1 million units, still the lease of the place will be 100,000. So if they're leasing, for example, the place or renting it for 100,000 per month, it doesn't matter if the company produces 1 million unit or 100,000 units or 10,000 units. It doesn't matter. The rent will be 100,000 per month. That's what we call fixed cost. That's why it's called fixed. It does not change whatever the level of output is. Level of output can mean the number of units produced. So if a company, let's say, if a company is into making chocolates, so there are certain months of the year where making of chocolates, the demand for the chocolates could be very, very high. So let's say February. In February, the company was producing, let's say, 1 million, or let's say 1 million, just to give an example, 1 million pieces of chocolate, whatever that is. The rent will still be 100,000. Or let's say in July, where the demand will be very small, let's say only 50,000. This is an example, 50,000 pieces. Okay, the rent will still be 100,000. Okay, no matter what the level of output of activity the company engages in, still this cost remains the same. That's what we call fixed cost. On the other hand, variable cost, as the name suggests, this changes or this varies with respect to the activity. Okay, suppose, let's say, a company makes use of, let's say, a certain ingredient in making the chocolate, let's say sugar. Okay, let's say that the company estimates that one piece of chocolate will consume 1 gram of sugar. 1 gram of sugar. So, if the company produces 1 million pieces of chocolate, will the level of usage of sugar change? Yes, definitely there will be more sugar utilized or consumed if the level of output was 1 million pieces as compared to just 50,000 pieces of chocolate. Okay, so this type of cost are what we call variable cost. Okay, and usually they can come in the form of the raw materials used. Also, this is raw materials used in the production. Also, direct labor. This is the cost as far as, let's say, salaries, wages of the production people, okay, is concerned. And we can also have factory overhead. These are other costs that may not be classified as raw materials or direct labor, but are needed in the production. All right. So these are the differences between fixed cost and variable cost. And what we want to to compute is what we call the break even. What do we mean by break even? For break even, it's the level of sales, the number of units of sales, where the company is just able to recoup or recover the fixed cost and the variable cost combined. So let's put this in a formula. Let's say X is the number of units. So this is your unit sold. Let's call SPU. This is your selling price per unit. Selling price per unit. And then VCU is your variable cost per unit. And we have, let's call fixed cost as FC. Okay. So let's construct now our income statement. Our sales will be equal to the selling price per unit multiplied by your X, right? So if we're selling it at 10 pesos per unit, multiplied by the number of units sold, that will be our sales. And then on the other hand, our variable cost will be equal to the variable cost per unit, multiply that by sales also. So if we subtract sales from the variable cost, we have what we call CM, or this is your contribution margin. Okay, and then your contribution margin is simply your selling price per unit times your X minus the variable cost per unit. And then we have to deduct the fixed cost. By deducting the fixed cost, we have covered all the costs involved, and the result is your net profit. Okay. So in general, this equation will be reduced to, so let's perform this equation. Let's write it down. So our sales is your SPU multiplied by X. Then we subtract the variable cost. So this is minus VCU multiplied by X. This is your contribution margin now. And then minus fixed costs. So this gives us now our net profit. Okay. So in general, if we want to compute for X, we can factor it out here. So that's selling price per unit minus variable cost per unit. Okay, let's factor out X. And then this is equal to fixed costs. We transpose fixed costs on the other side, it becomes positive, and then plus your net profit. Okay, therefore, there's a name for this. Okay, this is your contribution margin per unit. Okay, the difference between selling price per unit minus variable cost per unit is your contribution margin per unit. Therefore, our X will be equal to your fixed cost plus your net profit divided by your contribution margin per unit. Okay, so this is the formula that we can use when we're computing for when we want to determine how many units to produce. So for example, if you want net profit of 1 million, okay, so you can substitute 1 million here, substitute fixed cost, and divide it by the contribution margin per unit. That's the number of units you have to produce or to sell in order to gain a net profit of 1 million. However, at break-even point, at break-even point, okay, what's again break-even point? Break-even point is that level of sales where your net profit is equal to 0. So we're just barely covering the costs, all the costs, the fixed cost and the variable cost. So let's give it a name, Rx. So others will call it Q to signify that this is break even, just to distinguish it from other number of units. And it's equal to fixed cost, okay, divided by your contribution margin per unit, okay, which is fixed cost divided by selling price per unit minus variable cost per unit. Okay, so this is the formula for us to compute the break even, the level of production, the level of sales where our net profit is 0, and it's called break even. So in this case, let's solve it here. All right, so the formula for break even here, Q is equal to the total fixed cost divided by your contribution margin per unit. Okay, and take note, this is selling price per unit divided by variable cost per unit. Okay, so if we're going to follow the formula here, so this is equal to, okay, let me increase the, so using the formula, this is equal to, fixed cost is at 30,000, and then we divide it. Why don't we give this a name? So let me just type here the name fixed cost, enter. This one is SPU, let's call it selling price per unit. Oh, sorry, a mistake. Let's call this SPU, selling price per unit, enter, and this is variable cost per unit. There. So we now have names, fixed cost, SPU, VC. All right. So in order to compute for the break-even point, so it will be equal to the fixed cost. So that's fixed I'm sorry. Okay, fixed cost, and then divided by, so this is your selling price per unit minus variable cost per unit there. Or this is known as your contribution margin per unit. Enter. Okay, so we need to sell 15,000 units in order to break even. Okay, let's just show that here. Let's just prove that. Okay, so if the units sold, just increase the size. Okay, 15. So this is equal to, okay, 15,000. So let's see if indeed the variable cost, contribution margin, fixed cost, then profit, net profit. Okay, let's compute. So our sales will be equal to the number of units sold. Okay, multiply that by the SPU, right? The selling price per unit. How much are we selling the unit for? It's at 6. Okay, therefore we get 90,000. That's our sales. And then our total variable cost will be equal to, again, the number of units sold multiplied by our VCU, variable cost per unit. Okay, enter. So it's 60,000. Why don't we put a, okay, therefore our contribution margin will be equal to 90,000, our sales minus our variable cost. Okay, that's 30,000. And then our fixed cost, we know to be 30,000. Therefore, if we subtract the contribution margin, so this is equal to contribution margin minus your fixed cost, and we get a net profit equal to 0. Okay, so that's how we compute for the break even. So we say that the company needs to sell 15,000 units in order to break even. Okay, so of course we can use GoalSeek for that, but we have to first format our okay, let's put here the level of output. So our unit sales will be equal to this, multiply this by our SPU, right? Okay, so we would like Excel to find this number of units. I'm sorry, I think apologies. So this is the unit sales. Okay, so this is where we're going to put our level of output, our number of units sold. So our sales will be equal to this, okay, multiplied by your SPU. Our variable cost is, okay, let me just format this. It's in dollars. And later. Our variable cost is the number of units sold multiplied that by VC, variable cost per unit. So this will give us our contribution margin. Let's type that here. And our contribution margin is just the difference between this one and your sales less your variable cost. And we're getting 0 as of the moment because we don't have yet the level of sales. We can now link this to our fixed cost. There, fixed cost. Okay. So our net profit will be equal to your contribution margin minus your fixed cost. Okay. We're getting a loss of 30,000 because we don't have the units yet. So let me just format this, control 1, and then let me just make it, okay, maybe 2 decimal places will do. All right. Okay, so this is our sales revenue, and it's linked to the number of, let's call this, maybe we can call this BEP. Sorry. I'll call this BEP, break-even point, so that our formula becomes, if I replace B16 with this one, okay, it's now become BEP times SPE, right? And this one, let me replace this by BEP. Okay. All right, then we can use GoalSeek now. We can ask Excel to solve for the unit sales so that the net profit is equal to 0. So we can go to data, and then what if analysis, GoalSeek, set cell our net profit to equal 0 by changing the number of units. So let's see. Okay, you can see here Excel is iterating, and then we have this. And of course, we can solve the problem where we want a certain level of profit. For example, if we want units, okay, suppose we want the profit to be 1 million. The question is, how many units should we be selling? So that's the question. How many units do we need to sell in order to have a profit of 1 million? So that's easy. You can just follow the formula. Okay, let's write the formula here again. So X, okay, so this is the number of units sold, will be equal to your fixed cost plus your net profit divided by your contribution margin per unit. Okay, so given this formula, we know fixed cost at 30,000. We know the profit at 1 million. And also we know the contribution margin per unit, which is your selling price per unit minus your variable cost per unit. So this will give us, okay, so for the numerator, you have fixed cost. Okay, so that's fixed cost. Okay, then we add the profit. This is our profit. Okay, and then divided by your selling price per unit minus your variable cost per unit. Okay, of course, we could have another cell with the name CMU. Okay, but you can just do that for yourself. Okay, so Control Enter. All right, so we need to produce or to sell 515,000 units in order to have net profit of 1 million. Okay. Okay, so this in a nutshell is how we compute for break-even unit. Okay, so let's now go to this case. This is now for cash budget. Okay, let's read the case. So this company has forecasted that revenues for the first 6 months will be first 6 months of 2022. So that should be January, February, March, April, May, June. Okay, so these are actual figures. Let me just reposition this a bit. Okay, so the actual sales for November 2021 was 48,000, while for December it was 45,000. So the company is projecting that in January up to June, this will be the projected revenues. Okay, so we're told here that the firm collects 60% of its sales immediately, which means that when they sell in January 25,000, 60% of this will be collected in January and 39% will be collected the following month. So of the 25,000, 60% will be collected in January, while 39% will be collected in February. And then the estimate is that 1% will not be collected. It will be bad debts. Okay, so what are the cash outlay, the costs? You have wages and benefit, 7,000 per month. Commission is at 25% of collectible sales. And then the partners is paid 5,000 per month or 20% of net sales, whichever is greater. Okay, commissions and partner salaries are paid 1 month after the revenue is earned. There's a rent expense of 3,500. Lease of the equipment, office equipment is 800. Utilities is 250 per month, except in May and June when they are average only 150,000. We're also given that the ending cash balance in December 2021 was 12,000. Okay, we're asked to create a cash budget from January to June of 2022 and determine if the firm's ending cash balance in each month is sufficient, assuming that the company has to maintain a cash balance of 10,000. Okay, if the cash balance is not sufficient, then the company could take a loan from a bank. Okay, and the loan is in thousands. Okay, we are to ignore interest charges on the short-term debt. So we're going to create, let's create four scenarios. You have best case, base case, and then let's put here a pessimistic case. Oops. Pessimistic. Okay, so kindly include here pessimistic. Okay, and what's the best case? The revenues will be 10% better. The base case is exactly as expected. And then let's change this. 10% worse for pessimistic and 20% less for the worst case. Okay, and then we're asked to use the scenario manager and create a summary of your results. Okay, all right, so this is the case. This one, I created already the model. Okay, and the answers are here so that our discussion will be fast. Okay, but let's not touch this. Let's create another worksheet. So let's copy this, control, and then drag to the right. So let's work on this so that we preserve this one. Okay. So for this one, that's the modified one, the one that we're going to use. If we take a look at data and then what if analysis, and then here there's a scenario manager. And I already have created the 4 cases here. But let's just delete each one of them, delete, so that we're going to work on that on our own. All right. So I deleted the scenarios. We're going to create that on our own. Now take a look at how the model is done. Okay, here, okay, this is a cell that will now vary 100%. Okay, let's first take a look at how we model. This is our expected sales for 2022. This is the one given here. So this is 25, 27, 30, etc. So this is 25, 27, 30, etc. Now, for the cash budget, okay, we will create scenarios where the cash or the revenues, this is the sales, will be, the base case is that it's 100% of this. So it's as expected. This is our expected sales for 2022. So if we put here 100%, okay, so this is already the recorded sales on November and on December of 2021. And what we're going to do here is we're going to multiply our sales in January with the case. So if it's 100%, then we have here, we expect this to be 25,000 also because it's the base case. We call it the base case. And then we just copy this formula to the right. So if you take a look at this formula, this is 100% times the expected revenues in February. This will be 100% times that of March, etc. So if it's the base case, it's 100%. Then the sales, this one, the projected sales will be exactly the same as the expected sales. But if we change this, for example, I'll make it 80%, which is the worst case scenario. You notice that your sales projection, your revenue projection changes depending on the level of scenario. If it was optimistic, then this becomes 110%. So your sales will now be 10% greater than what's being expected. Okay, so with this scenario manager we will create for Excel to replace this with 80%, 90%, 100%, and 110%. So for now, let's just make it 100%. Okay, so these are our sales. For the collection, we have 60% on the first month. That means 60% cash, and then 39% after 1 month, and then 1% will not be collected. So how does this go? If you take a look at this, let's take a look at the formula. So the sales in January of 25,000, we will be able to collect 60%. So you notice here the formula is $B7. I'm fixing the column so that it will not go out of this column. Okay, but it needs to also go to the row. That's why I'm not fixing the row. Okay, so the sales of 25,000 in January, 60% of that was collected in January. There. Okay, so this is the collection during the month itself. Okay, then how about the 39%? The 39% is a collection based on the sales of last month. So for January, we have this 39% times the sales of December. Okay, so that's B8 multiplied by D5. Okay, so 39% of the sales on December will be collected in January. Okay, same thing here. For February, it's the sales of January multiplied by 39%. Okay, until up to June. So for June, the sales of 40,000 in May, 39% of which will be collected in June. Okay, so these are now our collections. So for January, collection of the sales in January and collection of the sales made in December, 1 month before. Okay, so we can now add, if we add now the collections in on that month and on the previous month, we now have our net collections. Okay, so also I wrote here some of the details given in the problem. Okay, so we have here minimum cash balance of 10,000. Partner salary is 5% or either 1% also. We're told that partner salary is either, where is that? Is either 7,000 per month. No, sorry, that's the salaries. 25% of collectible sales. Okay, sorry, it's 25% of collectible sales. Commissions, while their salaries are 5% per month or 20% of net sales, whichever is greater. Okay, so it's variable. So let's go back here. Clerical wages is 7,000. Rent expense is 3,500. Office equipment, 8,000. Utilities, 250, except for May and June, 150. So we have written here the details. Okay, so that we can link to this. All right, clerical wages is 7,000. All right, so we just copied it here, linked it here, 7,000. And we fix it so that it's the same for all the months. Okay, how about sales commission? Okay, sales commission is 25% of the, let's go back to the statement. It's sales commission is 25% of the collectible sales. Okay, and this is paid 1 month after the revenue is earned. So let's take a look at what we did here. All right. So there was sales in December, 45,000. Okay. So of the sales in December, 45,000. Okay. How much will be the commission, which will be paid in January? Okay. So let's take a look at this. Sales commission. You notice that the sales in December, so the formula here is B13. So this is the commission rate, 25%, times the sales on of December, okay, times 1 minus B9. Now, why did we subtract B9? Okay, because the commission will be based on what's collected. Okay, of the 45,000, only 99% was collected, which means 1% is considered as bad debts. So the sales commission will just be based on the amount that's collected. So 25% of 45,000 times 1 minus 1%. So only 99% of the 45,000 will be considered as part of the commission, and it will be paid in January when everything was collected already. Okay, and then we can copy this. Okay, to for February, sales commission will be based on the sales of January. Okay, 25% of that, and then 25% only of 99% of the sales of January. So we're excluding the 1%, which is expected to be bad debts. Okay, and that's for all the other sales here. So the commission for June will be the sales of May, okay, multiplied by 25%, and then only 99% of that. That's why we're subtracting the 1%. Okay, so that takes care of the commission. Okay, now how about the partner salaries? If you take a look at this, so we're told it's either 5,000 or 20% of the collections. Okay, 25%. Okay, same thing here. 45,000 of the sales of the previous month. Okay, it's this one. So 20% of that, of the collectible sales. Or, so we're using here max, whichever is greater. 5,000 or 20% of the sales, of the collectible sales based on the previous month. Okay, and then there's a times 2 here because they are two partners. Okay, so there's this option, either 5,000, this is 5,000. Okay, Control Z. Or this one. So in this case, 5, if we're going to get the commission rate of 20%, the 8, 9, 10 is higher. So this will be the one used. So the partners will pay themselves the higher between 5,000 or the commission based on 20%. Okay, that's why here in January you have 17,000 here. Okay, and the same thing for all the other months. Okay, this is how you do some modeling in Excel. All right, then the equipment list, we just get it from the list below, 800. And then take a look at this. So I'm saying here, if or month is equal to 4. The month, this function month of January will give us either the, if it's in January, it's the first month. Okay. The month function will give us the ordinal position of the month. So for example, this one also. So we're saying here, if it's equal to 5 or if it's equal to 6, then the value should be 150. Otherwise, it should be 250. Okay, because we're told that from January to April, the utilities is 250, but for May and June, it's 150. So with this one formula, enter. I just copy this to the right. Then it correctly already gives us the utilities. Okay, and then lastly, how about interest? So let's take a look at interest. So here we are now including, we're not disregarding the interest, we're including interest here. So interest is 1%, and it's based on the cumulative borrowing, how much the company has already borrowed. So if take a look at this, if D27 is greater than 0, so if there's a cumulative borrowing from the previous month, then we will multiply the 1% interest, this one, 1% interest multiplied by whatever is the cumulative borrowing. Otherwise, okay, otherwise it will be 0. Okay. If you notice, by the way, the if statement in Excel has this syntax. If, then we have logical test, comma, value if true, and then value if false. So that's how we construct the if statement. So let me flash that again. Okay. So we're not given any information about any cumulative borrowing as of December. So this is 0. So we're creating this formula so that we can compute for the interest based on how much was borrowed. Okay, so here, if this is the logical test, if the previous month cumulative borrowing is 0, is greater than 0, which means if this is a value, then we're going to multiply 1% times whatever that amount is. Okay, that will be the interest. Otherwise, so this is comma, the value if true, and then another comma, value if false. This one. If, however, D27 is not greater than 0, in this case it's 0, then we don't put any interest there. Okay, so if we copy this to the right, for example, this one, okay, so if you notice, if the cumulative borrowing of May is greater than 0, then compute the interest. The interest would be 1% times this one. Otherwise, don't put any value there. Okay, so you now have interest here because you have values here. But we're going to see this in a while. Okay. All right. Therefore, our total disbursement will just be adding our total disbursements will be E17. Okay. We will have to include interest, E18. So we have to include interest. Okay, so kindly change the formula here. So it should be E12 up to E18. All right. Okay, so now we have the total disbursements. We have total disbursements, and we have the total collections. Okay, so therefore, let's now take a look at the cash balance. Okay, beginning cash balance. So let's peg it here. Our beginning cash balance, okay, will be equal to the ending cash balance of the previous month. Okay, so initially when you're doing this, this is given, right? We're told that the beginning cash balance is 12,000. Okay, I think this should have been linked here. Okay, why don't we do that? Let's insert something here. And then beginning cash balance, 12,000. So this is equal to 12,000. There. That will be our ending cash balance for December. This is given. Otherwise, the others are formulas. Okay, so let's continue. So our beginning cash balance will be equal to the ending cash balance of the previous month. So this is just carried. Okay. All right. Then add collections. So you have collections above there. So we're now accounting for the cash. This is cash budget. So the beginning plus the collections and then minus the disbursements. So take note here, beginning plus how much was collected and how much is disbursed. So we can now get this beginning plus collections minus disbursements, and the formula will be the same throughout. Beginning plus collections minus disbursements. All right. Then we have this. Okay. We have another if statement. Now we're told that if the cash balance should be more than, it should be 10,000 or more. Okay, if it below 10,000, then the company has to borrow so that the balance will be 10,000 or more. Okay, in this case, our unadjusted cash balance is only 4,000. So we need to borrow from the bank or from the financial institution. And we're told that the borrowing here, the borrowing are only in increments of 1,000. So the company can borrow 1,000, 2,000, 3,000, 4,000, 5,000, etc. Okay, here, highest 1,000. Okay, so it cannot be exact pesos. Okay, so let's do this. Let's take a look at what we're doing here. Okay, let's take a look at the formula. So if the unadjusted cash balance, if E23 is less than the 10,000, then it means that we have to borrow. And how much do we have to borrow? It's 10,000 minus whatever this unadjusted cash balance is. Okay. Otherwise, if it's greater than 10,000, then we will not be borrowing anything. Okay, let's take a look at this. Since the unadjusted cash balance is only 4,000 plus, then we have to borrow. How much are we going to borrow? It's 10,000 minus 4043, right? So we're borrowing 5958. Okay, but we're told that we cannot borrow, we have to borrow either in thousands, the nearest thousands. So here we have to borrow 6,000, right? 6,000 here. So what we can do here is put the ceiling here. There's this function called ceiling. Okay, and then take a look at the function, the number. So this is the number and then comma. The significance is thousands. Okay, so what will happen is that it will give us the higher because it's a ceiling. If we want the lower 1,000, then we use the floor function. So ceiling, and we expect this to become 6,000. Okay, there. So we're borrowing 6,000. Okay, because we're not allowed to borrow it should only be in increments of 6,000, 7,000, etc. All right. So when we borrowed 6,000, okay, what happened? Our balance became 10,000. And our cumulative borrowing now is, take a look at this, is whatever the balance of our borrowing the previous month is, okay, plus the new borrowing of 6,000. So it's now, the cumulative borrowing is now 6,000. Okay, so let's go back here. For this, the unadjusted cash balance is 8195, right? So we will have to borrow here. And how much do we borrow? Same thing, 10,000 minus 8195. Okay, but we can just copy this formula because we already placed here a ceiling. Okay, copy this to the right. There. And notice the borrowing is in increments of 1,000. All right, so 8195, the unadjusted cash balance, we have to borrow 2,000 to make our cash ending balance greater than 10,000. Okay, and you notice that in the beginning cash balance, so the ending cash balance for January is 10,043. So the beginning cash balance for February is 10,043. So it now follows. Okay. All right. Then here we borrowed 2,000. Therefore, notice our cumulative borrowing will now be 6,000 plus the additional 2,000. Okay. So it now is 8,000. And take note also of the interest here. Okay, the interest is now, if the cumulative borrowing is positive, it means there's cumulative borrowing in the previous month. Okay, we're looking at March. In March, we take a look at the cumulative borrowing of the previous month. So we multiply this borrowing by 1%, right? So that takes care of the interest. Okay, and the cumulative borrowing. Okay, so this now is your cash budget. So we were able to take into consideration the revenues and the collections. So this is our net collections. And then our disbursements, how much cash are we going to put out? Okay, including the interest expense here. Okay, The red ones are the ones in formula. Okay, and then we plot the cash flow. First is how much is the beginning cash balance at the beginning of the month, and then we add how much is collected, and then how much is disbursed to get our unadjusted cash balance. Unadjusted because in case this amount falls below 10,000, then we will have to borrow in increments of 1,000. If you notice, every time we have an adjusted cash balance that's below 1,000, we will have 10,000, we will have to borrow. In April, the unadjusted cash balance was 14,276, and this is greater than 10,000. Therefore, okay, we need not borrow. So for April, May, and June, there was no need to borrow. Okay, and as of June, the cumulative borrowing was 9,000. Okay. All right. Now, notice that this is based on the base case scenario. What if I change this? Let's say I change this to the optimistic scenario. It's 110%. Okay, so everything here changes. Revenues changes, collection changes. Okay, so you notice here that for the first month, January, cash balance was 5543, so there was a need to borrow 5,000. Okay, and the borrowing as far as the best case scenario is concerned, the cumulative borrowing was only 6,000. Okay, but if it was, let's say, the pessimistic scenario where you have 90%, okay, so everything here changes because the revenues change, therefore the collections change, therefore your cash budget changes. So if it's the pessimistic case, then the cumulative borrowing as of June is already 14,000. And if it's worse, which is 80%, okay, how much will be the cumulative borrowing as of June? It was already 20,000. Okay, because this is the worst case scenario, 80%. Now this was all captured here. Okay, if I go here and then go to data, what if analysis, scenario manager. This was all plotted here. Okay, let me just show this to you. The best case scenario, so I go here and then edit this. If you take a look at this one, so I gave this a name, best case, and the changing cells is, let me just first, okay, this, let me cancel it first. Okay, so this is B5. This is where we're going to ask Excel to change the scenario. 100%, okay, let me just write it right here. For the base case, it's 100%. For the optimistic, it's 110%. For the pessimistic, it's 90%. 90% of your expected sales. And then for the worst case scenario, it's 80%. Okay, so this is a type of sensitivity analysis. Okay, let's see what will happen to our cash budget if this changes. If this changes. All right, so let me just show you, okay, how to do it. Okay. So we have this now. All right, data, what if analysis, scenario manager. Okay, so we're going to add, let's call scenario name base case. So our changing cells is this one. Okay. All right, then okay. Then it will ask us, what's the value of your changing cell? Okay, if it's base case, it's just 100%, right? It's the same as the expected sales. Okay. All right, then we add, let's see, we say it's the best case scenario. best case scenario, okay, then it should be 110%, right? It will change this one, and the formula for our revenues is linked to whatever this value is and what the expected values are. Okay. All right. Then another one. Let's do the pessimistic and also B5. The pessimistic case is just 90%, right? Okay. And lastly, we add the worst case scenario. Worst case scenario. B5 again. Click OK. And then let's put the value here. Yeah, that's right. 0.8 or 80%. Okay. Okay, so we have now plotted these 4 cases. Base case, which is if we see, edit, and then okay, we can see that the base case is 1 or 100%. Okay, check the best case, edit, best case, B5, okay, and it's 1.1 or 110%. Okay, we're just checking pessimistic case, edit, okay, it's 0.9, and the worst case, edit, okay, B5 also, okay, worst case is 80%. All right, so what will now happen? Okay, let's ask, not yet, sorry. Okay, so what will happen is that Excel will replace all of this by either 100%, 110%, 90%, and 80%. So let's now create a summary. Okay, we have a scenario summary, and let's see. I'm interested to know how much will be the how much will be the borrowing on, let's say, the first month. Okay, so I can click this. I'd like to know how much is the borrowing on the first month. Okay, because the cumulative borrowing on January will be the actual borrowing because there is no previous borrowing, right? So if I click OK, it will now create this one, a scenario summary. So this is the best case, a base, best, pessimistic, and worst. So it's telling us that in the base case, the initial borrowing for January will be 6,000. If it's best case, there will only be 5,000 initial borrowing. Pessimistic case, 8,000. And the worst case, on the first month alone, there will be 9,000. Okay, and this is very flexible. So let me go back here. What if analysis scenario manager? This time, I'd like to summarize not the first case, but the how much will be the cumulative borrowing in June. Okay, how much will be the cumulative borrowing in June? So I'm going to click this one, 20, okay, and then it will create another scenario summary. Okay, take a look at this. If it's the base case, the borrowing, cumulative borrowing as of June will be 9,000. But if it's the worst case, the cumulative borrowing will be 20,000. So it gives us the different values, each for the base, best, pessimistic, and worst case, depending on what result you would like to see. Okay? So you can click here, for example, if you want the an adjusted cash balance, then you click this. If you want the interest expense, okay, interest. Okay, suppose let's add another one here. Let's get the sum. How much will be the total interest expense for those 6 months? Now, Currently, it's 100% here, but we can change this. We can put here 90, depending on the case scenario. So if it's the base case scenario, the total interest will be 410. Okay, so let's put this in red. This is the total of the interest. So let's once again come up with another scenario analysis. What if, okay, and then let's summarize. Let's summarize this time here, the total interest. Okay. All right. Then it generated another scenario manager. So this time, since I changed this, I made it 100%. It now reflects current value. So what does it tell us? The total interest expense in the case of a base case scenario will be just 410. The worst case, which is the revenues will be only 80% of the expected sales, will be 840. So it gives us a plot of what will happen to interest expense when you have the base case, the best case, pessimistic, and worst case scenario. Okay, so we have here 3 scenario managers depending on, it tells us what the result here. I think for the first one, okay, we should have written here total interest so that we know total interest expense. Okay. So that we know what the scenario manager is. Okay, so should you have any questions, please feel free to just PM me. Okay, so this takes care of the discussion on cash budget. Oh, in the finals, it will not, of course, require a scenario manager. But what's important here is for you to learn how to, for example, plot the cash collection based on certain givens, like this one. Okay, we're told that the revenues of a particular month, 60% of that will be collected on the same month, and 39% will be collected on the following month. So which means here in January, we will have collections coming from sales of December, and it's only 39%. Okay, because the 60% of the sales in, okay, so actually of the sales in December, the 45,000, 60% was collected in December. But I'm not putting that because what we were asked to be budget is January to June of 2022, because this is already historical. Okay, this is what we're budgeting. We're taking a look at how much will be several things. How much will be our disbursements? How much will be our interest, if any? Okay, so let me go back here. How much will be interest? Here I added interest, and it will depend on whether our forecast, okay? By the way, this is called the percentage, not strictly. The most popular method in forecasting financial statements, in particular, for example, sales, is the percentage of sales method, and that's discussed in the PowerPoint slide. Okay, so okay, that wraps up our discussion for this worksheet. Thank you so much.